Kavita Bharatake from Cherry Street Investments. Today, I want to take some time to explain the concept of capitalization rate, or what is more commonly known as cap rate. I was talking to an investor today and explaining how cap rate works and what the effect of cap rate on the value of a property is. So I want to spend some time today explaining what I know about cap rate. And I'm sure you've heard different explanations, but I hope this one makes sense to you. So I'm going to share my screen here for a second to explain this better, because I'm a very visual person and I think I understand it better when someone shows me something. All right, here goes. So capitalization rate, or what is known as cap rate, is a measure for assessing the real estate investment for their profitability and return potential. So what does this mean? This means that it's basically the yield of the property, assuming you've invested all cash, and it's the 1-year yield of a property. So let's take an example here, which will make it a little bit easier. Cap rate is defined as the net operating income of a property divided by the value of the property times 100. Now, there's a lot of terms in there that I don't want to throw at you, so I'm going to explain each one. The net operating income, or the NOI, is the income of the property after all expenses, but not all, because it doesn't include debt service or payment of mortgage, what we call debt service. So the NOI is the total income of the property minus the total expense that the property incurs, which is property taxes, insurance, all the repairs and maintenance of the property, but not including debt service. We don't include debt service in the NOI calculations for a few reasons. I think the primary one is you can get every owner could get a different interest rate, a different term, and the NOI, or the bottom line, will be completely different depending on the debt you take and the down payment you put down. So it's easier to evaluate a property in terms of its raw numbers, which doesn't include the debt service. So in this case, the debt, like I said, the NOI is without debt service. It's always without debt service. There's never a case where you actually have NOI with debt service. So when someone says NOI, it's income minus expenses. So in this case, I'm selling a property, let's say, with an NOI of $100,000, and the value of the property, or the price I'm asking for, is $1 million. Then the cap rate of the property is simply 100,000 divided by the price, which is $1 million, times 100, because it's a percentage. So we have a 10% cap rate. You're not going to see 10% nowadays in most big markets, but it is possible in smaller markets. So cap rate is usually proportional. We'll talk about what determines the cap rate. The cap rate is usually proportional to the perceived risk of the market. So for example, let's say you're investing in Austin, Texas, and I actually live here. So Austin is a very low risk, low cap market right now because everyone wants to invest in Austin. So the cap rate's really low. What does that mean for you as a seller? It's great because the low cap rate means high value. So in your equation, let's say your value is equal to NOI divided by cap rate times 100. So the lower you can push the cap rate, the higher your value goes up. So as a seller, it's a great thing to have low cap rates. As a buyer, not so great, right? Because as your cap rate goes down, your value goes up. And now you're faced with paying much more for the same property because the cap rates are lower. So that's what happens when you come into a market like Austin or Phoenix or Dallas. The cap rates are continually going down. As a buyer, you're paying more for the property because now the value is going up. Now, as a seller, it's great to have a really low cap rate. So basically, you're getting much more for your property when you're selling. So one of the things you need to keep track of is that when you are looking at a deal, when you're looking at an investment, you want to look at what is the exit cap that they're predicting or they're assuming in their pro forma or the calculations they're doing for the property. Now, let's say the entry cap or the prep that we purchased for was 4%, you want to make sure that the underwriting at least maybe a 5% or somewhere around there at exit. Why higher? Because higher assumes that you're going to sell it for less because the market conditions might not be as good as it is today. Because when the market conditions are better, your cap rate goes down, right? The property is valued more. When your market conditions are worse, your cap rate's going up, so your value is lesser. So I hope that makes sense. So coming back to the slide, a high risk, high cap market like Brownsville, for example, might be even a 10% cap rate because people are not as willing to invest and take the risk of a high risk market when there's no jobs, or the market is dependent on, let's say, just oil, and it's great is when it's going up, but it's not so great when it's coming down because there's no other source to hold that market up. So usually you want to obviously not take too much risk, but also get better returns. So you have to kind of weigh and figure out what market's right for you. Now, also, the different classes of apartments, A, B, and C, trade for different cap rates. Now, if you're not familiar with A, B, and C, let me give you a quick overview. A Class A apartment are the newer buildings, maybe the 2000s, 2010s, or the newest ones, ones coming online as well. The Class B apartments, so even in A, you have A minus, A plus, just depending on how new it is. There isn't much repairs to do, they're new buildings. The Class Bs are the little bit older, maybe 80s, 90s buildings, and the Class Cs are usually 60s, 70s. So depending on the class, obviously the cap rate changes for a given market. So let's go to Dallas. The cap rate for a Class C might be around a 5.5, maybe even a 6, but the cap rates for an A might be 4 or 3.5. The cap rates for a B might be somewhere in the middle, around 4, 4.5. So depending on the class as well, the cap rates will fluctuate within a given market. And it's also dependent on the sub-market. So for example, a sub-market like Irving in Dallas might trade at a much lower cap than maybe some parts of South Dallas that are high crime, low income areas. So you have to keep all that in mind. And it isn't just, oh, the cap rate's high, great, I want to do this deal. It isn't as easy as that to evaluate. So, and you also want to look at, you have a purchase cap of 4, but what are the sponsors looking to push the cap to with their value add and rehab? Maybe they're buying it at a 4, but they plan to push it to a 7, where the property is generating that much more income because your NOI is going up. So you also want to keep that in mind. I hope that makes sense and gives you a little bit of perspective into what capitalization rates or cap rates mean. Thank you for listening.